Welcome to the Explainer. Today, we're going to jump right in and decode a section that's absolutely fundamental for any tax professional or property owner, Section 24 of the new Income Tax Act 2025. This is the one that tells us exactly how to handle the taxation of income from co-owned properties.
So, think about this. It's not just some textbook problem, right? This is a super common question we see all the time in practice. How do you correctly figure out the tax when you've got multiple people sharing rental income? Well, the definitive answer is right there in the framework of the new law.
All right, so here's our game plan for today. We'll start with the core legal principle, then we'll walk through a practical calculation, cover the essential compliance checks, point out some common pitfalls to avoid, and wrap it all up with the key takeaways.
So that very scenario we just talked about, well, it highlights exactly why we need clear legal guidance. Thankfully, the law addresses this head-on in Section 24, which is designed to bring some much-needed clarity to the whole issue of taxing co-owned properties.
Okay, let's get into the nitty-gritty. Section 24 gives us the specific rulebook for assessing income from properties that are jointly owned. The whole point is to avoid any ambiguity and make sure every owner is taxed fairly, based on their actual share.
The big idea here, the core principle, is individual assessment. The law is really clear. We are not lumping the co-owners together into one single taxable group. No, the focus shifts completely to assessing each owner as a separate individual. And that distinction is absolutely crucial. And here's the exact wording from the law itself. It's pretty precise, isn't it? It says co-owners shall not be assessed as an association of persons, or AOP. Instead, their income has to be calculated separately. It's this clarity that really helps prevent tax disputes down the line.
Now for Section 24 to even kick in, there are two critical conditions, and these are totally non-negotiable. First, you obviously need co-ownership. But second, and this is the real key, the shares of each co-owner have to be definite and ascertainable. What does that mean? It means a legal document, like a sale deed, must spell out the ownership percentage. Whether it's 50-50, 70-30, you name it. Any ambiguity here is a complete deal breaker.
And, the difference this makes is huge. When Section 24 applies, everything gets handled at the individual level. This usually means a lower tax bill overall because each person can take advantage of their own tax slabs. But if those shares aren't clearly defined, well then the income gets pooled and taxed as an association of persons, or AOP, which can easily push you into higher tax rates and is way less beneficial.
All right, theory is great, but let's make this real. Nothing beats a practical calculation to see how this all works in action. So let's walk through an example and see exactly how income from a co-owned property gets computed and taxed.
Okay, so let's meet Priya and Rohan. Imagine they co-own a property, and the deed is crystal clear. It's a 50-50 split. We're going to use their rental income and expenses to see exactly how Section 24 is applied correctly.
And look at how this breaks down. It's actually pretty straightforward once you see it. We start with the total gross rental income of 6 lakhs, and boom, we split it right down the middle. Then every single item after that, the municipal taxes, the standard 30% deduction, even the interest on their housing loan is also split perfectly according to their 50% share. That final number, 1,03,000 rupees each, is exactly what they'll report as taxable income on their individual returns.
See, the math isn't too complicated, and this is a big but. It all depends on getting the compliance right. So let's go over the essential checks that both you as professionals and your clients need to do to make sure everything is spot on.
You really have to think of this as a checklist. First and foremost, documentation is the absolute linchpin. Steps 1 and 2 are non-negotiable. You need a registered deed that explicitly defines the ownership shares. That's your foundation. Without it, you can't even begin to do an individual assessment. Then, you back that up with clear financial records. The final step is just the execution. Each co-owner reports their bit on their own tax return. Follow these steps and you're set.
Okay, so knowing the rules is one thing, but knowing where people usually trip up, that's just as important. Let's take a look at some of the common practical pitfalls that can lead to wrong filings and, those dreaded tax notices.
Let's run through some of the classic mistakes. The biggest one, by far, is not having that registered deed that spells out the ownership shares. Another one we see all the time is one co-owner just declaring the whole income, which can totally backfire and push them into a higher tax bracket. And hey, professionals, you want to pay close attention to this next one. Don't forget the clubbing provisions.
For instance, under Section 25A, if a property is transferred to a spouse without getting enough in return, that income gets clubbed right back to the person who transferred it. That's a critical detail that's so easy to miss and can cause major compliance headaches.
Whew, okay. We've gone through the law, the math, and the common mistakes. Let's pull it all together and boil it down to the absolute essentials you need to know about Section 24.
So to wrap things up, I want to leave you with 5 key principles. If you remember these 5 points, you're pretty much golden when it comes to taxing co-owned property.
First up, assessment is always individual. They're not a group. Number 2, this only works if the shares are definite and written down in a legal document. Third, everything gets split proportionally. That means income and deductions. Fourth, and I can't say this enough, documentation is king. That registered deed is your proof. And finally, number 5, each owner reports their own share on their own return. Nail these 5 points and you'll be in a fantastic position to handle co-owned property tax correctly every time.
And that's a wrap for this explainer. I really hope you found this session valuable. If you did, please go ahead and like, subscribe, and share it with your colleagues and your professional network.
Just a reminder, this video is for educational purposes only, and it does not constitute professional advice. Tax laws can and do change, so please always consult your professional advisor before taking any action. This is an AI-generated educational video.